Hello and welcome to New Future. In this video we're going to talk about inflation and people's wages. And I wanted to explain the bear case for this suggestion and explain that it's not so easy just to go ahead and up the price because it has broader effects on the larger economy in general. Now, this, as I said, is the bear case. If you wanted to know the bull case for this, please let me know in the comments, because this is a very complicated subject and there is pros and cons on either side of the debate, but I'm going to focus on the bear case. So in order to do this, I'm going to break down businesses, what they are and why this isn't such an easy thing to do, as it might actually do more harm than good in the long run. Now, just before I start, I'm going to preface this by saying this isn't necessarily my point of view or anything. This is discussing this in a larger context. So let's begin by discussing a business. So there's a lot of misunderstandings about business in the common discussion, and we need to break those down first before we can get a better understanding. So what is a business? A business is an entity. This can be a company, this could be, in Australia we have what's known as a sole trader, which is effectively a one-person business connected to your personal self, or we can have a number of corporations. Now this conversation is easier to have with smaller businesses. Corporations work very differently, and there's a lot of things I think corporations need to work on. But let's focus this on just the small to medium-sized businesses and how this can have a long-term effect. Every product or service will have a margin. There is the costs of that product or service versus the selling amount. Let's look at retail, since it's something I understand. I am a director of a retail business. You always want to look at your margins. Most margins would sit around, let's say, 30%. You'll buy a product for one price and you will sell it at 30% more than what you bought it. You then taking that 30% as your profit. Most places will have a set margin or a target margin that they will sell their product for. That would be usually, let's say in this case, it might be 30 to 40%. In larger businesses that sell a lot more, they will decrease this to maybe 15%. With businesses that sell less, they might bring that to about 50%, so that it sort of evens out the operational costs versus the income coming in. Obviously, we're not making assumptions here about every single business that exists. Now, before I start, I just wanted to play a little bit of a clip from Johnny Harris. Now in this he tries to explain inflation, and he uses as a sort of a small business as at the start to sort of explain this. Now I actually don't think his explanation is actually correct, and it exemplifies a misunderstanding. Now in his defense he does explain it further on in a bit more detail, but just this small clip here I wanted to play you to explain it in a bit more detail. So let's watch this little clip and then I'll jump back in.
Villagers now are going to their market and they're buying way more stuff. Many of them have been eyeing the fancy electric bike in the market that before they couldn't justify, but now they totally can because they have all this new money. The store owner's like, sweet, this is great for business, but he's running out of bikes. In fact, he's running out of everything because now all of these people have extra money and they're buying way more than they used to. The store owner's like, I can't keep up with all this demand. I should raise prices. And that is inflation.
And this description here is the common perception about how business works. But as we discussed, shops don't randomly pick prices. A store is just the gateway to the customer. And I understand this quite well. As I said, I own a company that works in retail. So let's have a closer look into where the price rises actually come from. So you've got the manufacturer, you've got the distributor, then we've got the retailer. Usually the price increases don't come from the retailer, will come further down from the manufacturer or the distributor. So let's say the operational costs of the manufacturer go up, which we're seeing in the last year or two. Material costs are going up and it's harder to get suppliers to create the product that they're selling. Therefore they have to up their price. That price will get passed on to the distributor, and the distributor will then pass it on to the retailer. Both the distributor and the retailer tend to work in margins, and margins alone. And all of the costs that get involved are usually coming further down the line. Their prices aren't chosen at whim by the retailer. With that said, in some cases, the price has to go up by the retailer. Usually not from the lack of supply, but rather from business variables, which make it impossible to run a business without raising the price. It's only in some situations, such as the property market or car sales, where we can see a clear difference when availability dries up in short-term periods. With that understanding, let's jump into how businesses work and how this idea of increasing wages will affect the overall running of a business and the price at the end of the day. So let's create a scenario here. There is a retail business, let's call it Products Are Us. Not a very original name, but let's run with it. Let's say this store on the corner would make $1 million in sales a year. Anyone who doesn't really understand business would say, wow, they're making $1 million. That is great. Well, we have to discuss what we mean by making that in sales. That is what we call gross revenue. That means that is the money coming in. But we have to also recognize the money that's going out. And so then if we are ignoring tax for this, just to keep it simple, if we look at this and say that their margin is 30%, this means the money that they actually get after buying the product in the first place, that brings that operational income down to $300,000. But it doesn't stop here. Let's say rent is another $50,000 a year. That will bring us down to $250,000 a year. Now let's say we have staffing costs. That would be another $150,000 a year in staffing costs. Now we are down to $100,000 a year. Now let's factor in all the other costs. Electricity, internet bills, all of the other services online like accounting and any other services that might be involved. This could be another $80,000. This actually means that our net income is actually only $20,000 a year. We've gone from $1 million a year down to $20,000 a year. And that is the business's profit at the end of the year. Now, this is a best case scenario. Actually, most businesses won't actually see a net profit for years. And that's the point we need to understand here. Businesses sound great on paper. They made $1 million, but in fact they didn't. That is their gross income at the end of the day. And this gets even more confusing if we look at the owner of the business. If this is a privately owned business, and let's say 1 or 2 people own it, well, unfortunately, they get paid last. And this is a misconception. People think of these business owners as rolling in money. They get to live these amazing lives with lots of money. When in most cases, if we break away from these large corporations, that whole perception that the people at the top, the people who own the businesses, the owner is always seen as the person who is benefiting the most. But they get paid last, which means that they actually benefit the least. Now, this is obviously ignoring the fact maybe if you sold the business and you do receive those profits, but that isn't a discussion for today. So how does this all play into the bigger conversation that we're having? Well, what all this means is that even though the businesses might have a gross revenue, gross meaning before you take any deductions out of that income, and net, again, with this best case scenario, which is about $20,000. This is seen about standard for a business that is sort of doing okay and has already developed. Most businesses don't actually see a profit in the first few years, so keep this in mind. But why does this matter? Let's look at these shoes. These shoes are sold at this store and they're sold for $100, let's say. To keep this easy, let's say that they bought this from the wholesaler for $60. This means their gross profits after buying that product is $40. The point we want to look at here, which is $150,000 worth of wages. What happens if wages have to go up? Then this is going to change this equation. Let's say that the wages went up to $175,000. What this means now is, our profits are now down to minus $5,000. That means that we are now losing money. So to counter this, what do we have to do? We have to, bring the price up of these shoes to make the difference, to make sure there's enough money coming in to counteract this $5,000. That means our shoes now go up to, let's say, $120. And this is what we're seeing with inflation. This is the overall cycle that we see play out. This now means that Tom, one of our employees, all of a sudden, his money doesn't go as far. So what do we have to do so that he can continue to have a great life with the income that he's used to? We have to then go ahead and increase our wages again. Now we have to increase it to... The first time we might have counteracted the increase of the wages, we actually have to go and do that again. And that means our shoes are now worth $150. And this is the never-ending cycle which the governments are trying to avoid. You increase the wages too high, that means the cost of goods go up. That means we have to bring wages up again, and that means the prices of the products or services have to go up again. This one factor will actually play out through all of these. For instance, our services cost will go up as they're going through the exact same thing with their own staff and products. And therefore our services cost will go up. Our products of goods that we buy will also go through this same cycle, which means that the products of goods go up. And we see this never-ending cycle that will just continue to play out again and again. And this will continue until we have a runaway inflation, and no one can cap it. And that's what we're seeing in a lot of these countries in the world, where runaway inflation turns the dollar or whatever their currency is into something that's worth nothing. So hopefully this makes sense. If you've got any questions, please chime in. I'll see you in the next video. If you'd like to see a bull case for this, let me know and I'll do that in the future. Otherwise, have a good one. I'll see you next time.